Let us very quickly start looking at the interest rate markets, and here we see more of the same for this week. If you remember, we drew these channel lines last week for the 2-year note, the 5-year note, the 10-year note, and even the very strong supply that we had this year, this week rather, and the retail sales beat produced just a very slight dip and a full retrace almost immediately in the 2-year note. Basically, the market does not believe that the Fed is going to hike anytime soon, or if it's going to hike, it's going to be anything more than a single hike sometime this year, which makes sense because as we get closer to the presidential elections, we very much doubt that the Fed is going to hike. So the 2-year note is very strong. These channels are holding it very well indeed. Now, if we look at the 5-year note, the picture is even better. Very slight dip and full retrace back to the middle of the channel. The moving average, the 200 period moving average, is positively sloping. Very difficult to short these markets at the moment. Absolutely no reason to short them. 10-year note, again, even better, just showing you how the curve is flattening. It couldn't even bust the 50 period moving average and straight back up to the top of the Bollinger Bands. This is a full, risk off profile, with the 2-year note stagnant, the 5-year note slightly bullish, the 10-year note quite bullish, and finally the 30-year note, 30-year bond, even stronger than the 10-year. We think this line is in danger sometime next week. If we had to have a position, we would be long this contract. We would try to buy it somewhere below 166 to try and resell it around these levels, which would be what, 169 nearly. We think this will be retested. This area here will be retested sometime next week. This is an incomplete look to the bullish pattern. We need a bust through this line and a spike up to 169, 170, and we think we're going to get it sometime next week. In the European markets, the Schatz, this is this week. Absolutely as firm as a rock on the downside, mind you, firm as a rock on the upside as well, but it's just showing you that there is no pressure on the downside at the moment. Not in the 2-year note. The bobble, which is the 5-year, slightly better. Basically 2 to 5 years absolutely flat, very close to busting this top area here, which is 131.56. If we bust that, I think we will definitely try to make some work up towards 132, 132.25. Not a time to short it, really. And finally, the Bund, which is even more bullish, going straight back up, just like the 10-year note, towards the 164.60 area. It couldn't go below 163.25. It tried a couple of times last week to go down, but nothing. The 200 period moving average is turning as well. MACD will turn. So if anything, we think this area 164.60 is in danger, and we will try and bust towards 166 sometime next week. Let's start the equity review from
EEM, which is the Emerging Markets Index. This is a weekly chart, and we have marked here two very important levels, 3150 and 2978. These levels we think might get tested next week. It's going to be very, very interesting to see if we can come back into these areas. And as you can see, this market has actually been leading for the past couple of weeks, equities lower. It reversed sharply from the 35 area and is now down at 32 and a quarter. That has made the S&P 500 retrace for the moment 23.6%, but we're hoping that it might bust through and come into this area, which is the 38% retracement around the 2000 area. A lot of people are talking about this being a huge head and shoulders top, targeting God knows what, 1900, 1800, whatever. So a lot of people are positioning themselves short, and there have been some massive outflows out of equities. This month, 90 billion left equities. So we are uncertain about what is going to happen. We certainly have risk off, but we also have a market which is not positioned long. Therefore, we are absolutely not in the camp that's going to look for a collapse here. The transports have also been leading for the past few days on the way down, and we're approaching this massive trend line here, which is around the 7,250 area. You can see it held once for a huge bounce. It held again for a bounce, and then finally when it broke through, the market collapsed. But this time we think that this is around the 50% retracement of this whole move, and we should come to this area here and we can see what happens. The other charts which are very interesting are the NYA, which is the NYSE All Stock Index. We think that might come to around the 10,000 area next month, which would be about 2% lower. 2% lower would put the S&Ps somewhere around the 2,000 mark. So we have a confluence of indicators all pointing to the market being down 2% or so, and being at a very, very interesting juncture. The same thing can be seen actually in the stocks. We think that we might come down to the bottom of this Bollinger Band around the 2,800 or even lower area. In the cash you can actually see it much better. We'd like it to spike to 2,800 to 2,700 into this box here, and we can see the same thing in DAX, which is much better supported. It might come to 9,500 or lower, this kind of area. Maybe people are starting already to talk about filling this gap. Now, why are we not in the camp that says collapse? Apart from the fact that we have a presidential election, and therefore Janet Yellen is going to do absolutely everything in her power to stabilize markets. We also have a situation unlike the beginning of the year. At the beginning of the year, oil was here, 32 bucks and heading lower. Now oil is 46 bucks and heading higher. Commodities at the beginning of the year, this is where they were and heading lower, and now they're much higher. The commodity indices are all higher than they were at the beginning of the year. In fact, they are at the same levels that they were at the beginning of the third quarter of last year. Gold has already done its move, and actually it's quite significant that in a week when we had a weaker stock market, gold finished the week down. It couldn't even fill the little opening gap that it made. So we think that that is quite indicative that not everything is pointing to risk off. In fact, we would not be in the slightest bit surprised if gold actually fell down to the bottom of this channel around the 1200 mark. It would not surprise us, because it is unlike previous collapses. There are no not everything is coming together at the same time. Commodities are trending up or not coming down, and the market is already quite oversold, and people are getting more and more and more and more bearish. So we think a move to 2020 to 2000 will see a very, very nice retracement bounce after it. Whether then it makes a new high or just goes and tests that line, we don't know, but we don't particularly care. We think that this risk reward says around the 2000 area you want to be long. So if we just have a look at the retracement levels, everything points to the same kind of area, just around 2000 for the 38.2 retracement, which could be a quick move. It could take 2-3 days, and once you bust this area which has been so supportive for so long, which is the 2040 area, 2030 area, you could see a massive acceleration, as you saw here. In a week it came all the way back to from 2060 down to 2000, a 3% swoon, and then we could have the possibility of busting the top of this range. That is what we're looking for, because we like contrarian trades. This is a market which is trading very stable. If you dumped 90 billion worth of equities, you would have thought that the market would go down in a straight line. It hasn't. It's traded. It's traded up, it's traded down, it's traded up, it's traded down. It's trading every tick. There are absolutely no gaps in this market. So that makes us think that even on a monthly basis, we could come back, get everybody bearish, around 1994 area, and then bust to the upside. Everybody's talking about we are in a bear phase, we are in a weak seasonal phase for equities, and yet the market is trading much firmer than one would expect, given the fact that so much is being sold into this market, and it's just remaining supported. That's why we think that we will have a spike in the bunds, a spike down in the in all the various indices in equities, and we are undoubtedly in an equity risk off period, but somewhere around these levels, in the Wilshire 500, which would be another, from 21,000 to that would be another 3 to 4% lower. Around this level, you could certainly give it a go on the upside, just below the 200-day moving average. That is what we want to do, and we will be doing it via options. So we are very much set to be contrarians next week. And we certainly think that next week will answer a lot of questions. Are we in a permanent risk-off area, or are we just in a time of sideways trading to let's put a trend line here and let's see what that looks like. No, that doesn't tell us very much. Let's put this one in here. Now that would be nice. That would be nice if we retested this this trend line and we held it. Now that would be interesting, and then we can go up. Now let's see if the commodity currencies actually support our view. Canada tends to lead, and this is what we are looking for in Canada. We're looking for a quick move back up to the 38.2, which is around 133 area. Then we are looking in Australian dollars. Very bearish profile, but here we're coming to the 200-day moving average, and we're also coming to major support around this area here, which is 71.27. So basically that's what we are talking about. We're talking about 2-3% in everything, and then the possibility for a major bounce. The euro, which as you know we also look for as an indicator to see if there's going to be any reflation, well, it's not surprising that last week it fell, but again it's coming to this kind of area which has supported it very well before, which is what, 110. 110 to 110.50 is the yearly pivot point. So we wouldn't be surprised again from 113 to get towards 110.50, 111, again 2 to 3%. So everything in these markets is actually pointing to a 2-3% move in equities lower, a 2-3% move in commodity currencies, a 2-3% move possibly in oil back down, and then finally everything gets rebought. Here it is, 40 to 40.50. From up here, you know, we could easily get a 10% move down in oil, but it's just not that significant compared to what we had at the beginning of the year. Much lower levels and the market going down, as opposed to maybe the market just coming down or going sideways. So we do not believe that this is the start of a really intensive bear phase in equities. If we look at the now, if we look at the Yardeni earnings evaluations, here we are. Valuations are stagnant, and the 16 times valuations area just below the 2000 mark. So that is a perfectly reasonable target for us to achieve. Our views will naturally evolve once we're trading around that 2020 to 2000 area. We shall be very attuned to the most minor changes in market behavior. Therefore, our positioning is not set in stone. We will not buy automatically 2020, but we will keep you updated via Twitter as we see changes. We might well let it ride to 2008 to 2000 before we start buying calls, and we certainly want to keep on buying, scale in, throughout this whole area between 1980 and 2010, 2020. This to us is the buy area, but we shall refine it with the lower timescales as the market gets there. But certainly it will prove to be a very pivotal week, because if it can't come any lower than 2000 or 2020 next week, with all this selling and all this bearish bias, with the with talk of huge head and shoulders, etc., etc., we will certainly be turning very, very bullish. This would be a very nice level, 1985, 1987. It would be fantastic, and we could have a very, very nice bounce all the way back up to over 2100. So that is what we're looking for. We're looking for a pronounced risk-off trade, being so both from a fundamental and a technical perspective. This 2000 to 1980 area is going to be quite pivotal. We think we get there, but we think it's going to be a buy certainly for the next 2 or 3 months into the end of summer. So we definitely think that we test these support lines, these support levels. EEM is going to be the leader. It would be very, very interesting to buy it at these levels, which we will, and we will keep you updated on Twitter throughout the trading week. Whatever happens next week is going to be a massive trading week, and we'll probably decide the direction of the market for the next few months. Thank you.